The video.
Professor,
Yep.
can we just briefly go back over long-term asset disposal?
Long-term asset disposal. This was the adjustment. This, right?
Yes.
Okay. Do you want me to go over this?
Yeah, that would be great.
Okay. Okay. I can definitely do that. Okay, so it's 6:05, so why don't we get started? Before we get started, oh, hold on, did I think I hit the record, right? Any questions before we get into our today's lecture? Okay, no questions. So for now, one of your students asked me to go over this disposal question, so I'll go over them. So this was, let me remind myself. Okay, chapter 7. Chapter 7 focused on long-term assets. Okay. So we talked about the acquisition price or the purchase price of assets, and we talked about depreciation methods and amortization if we're talking about the intangible assets. And also we're going to talk about the disposal or the sales of your long-term assets. And these are for possible scenarios or possible transactions that can occur with respect to the disposals of the long-term assets. So let me just go over this. So the original cost of the truck is $48,000. The residual value is $5,000. Service life is expected to be 5 years, and we're going to assume the straight line depreciation. Oh, so it's basically given. So we're not going to calculate the yearly depreciation using the straight line method. It's given here. So the question is asking, what if the truck is sold after 3 years for different values? So the first thing that you need to do is to compute the book value, or I call it carrying value of the asset. Okay. That's the first job needed to do. So for year one, you're starting from $40,000, okay? Minus you're going to depreciate by $7,000. So at the end of year one, your book value becomes $33,000, okay? At the end of year two, we're going to follow the same procedure, 33K minus 7K, that becomes the carrying value of $26,000. And at the end of year three, okay, the carrying value of the truck now becomes $19,000. Okay, so that's basically the dollar value that the company will report at the end of year three. Okay, now the question is saying, what if the truck or the asset is sold for $22,000? Okay, that's the first case. Now, so I mean, let's just start from here. So your value or your carrying value is $19,000, but you're selling it for $22,000. So I guess intuitively you're making a gain of sale. by $3,000. Okay, that's what's going to happen in your journal entry. So go down. So if you're selling your truck, you're going to credit your truck, right? Now, keep in mind that we're going to use the original value of $40,000. Okay. Now, so far, your accumulated depreciation is 7,000 times 3, right? So that's total of $21,000. So at the end of year 3, as you can see, you have the carrying value of or a book value of the truck at $19,000. So that's your disposal of your asset. Now you're going to sell it for $22,000. So in a sense, what that means is that you are going to receive cash of $22,000, right? Now, we always know that these debits and credits have to balance. So the debit side, we have a total of $43,000. Now on the credit side, we have only $40,000. So in order to balance, we are going to credit something of $3,000, and that should be the gain on sale of the truck. Okay, now that $3,000 basically equals the gain that we just talked about from here. Okay, so this is the journal entry at the disposal of your truck. That was the first case. Now the second case was we have the carrying value of $19,000, but we are going to sell it for $17,000. So when your value of your truck is 19, but you're going to only sell it at 17, that means there is a loss by $2,000, okay, intuitively. So we're going to follow the same procedure. You're going to debit accumulated depreciation at 21,000, and you're going to credit truck. The original price was 40,000, okay? And on the debit side, you're going to receive $17,000 of cash. So there's a cash of 17,000. So let me do the debit side and credit side. On the debit side, you have 38,000. You have 40,000 on the credit side. So that means you have to include additional debit of something at 2,000. And in this case, it's going to be a loss on sale. Okay. So that 2,000 basically comes from this. Your value of a truck is 19, but you're only going to sell it at 17. Okay.
Can you go over the loss gain? I understand mathematically what you did, but why debit credit for loss and gain?
So basically gain is kind of similar to revenue, right? You're making some, yeah. So when we record a revenue, we usually credit it. And for loss, it could be, I mean, it's quite similar to expenses. Whenever we record expenses, we usually debit expenses, right? So that's basically the intuition that you can base.
So gain is like income.
Yeah, gain is like a revenue, but it's a non-operating gain.
Yeah, but it's still in thinking of debit and credit. That's the right way to think about it.
Yeah, that's the easiest way to get around it.
All right.
Gain is similar to revenue, so you credit it. Loss is similar to expenses, so you debit it.
Sure. Okay. Thank you.
Do you, whoever asked me, do you want me to go over the last two, or that's pretty much good?
It would be nice to go over the last two. I didn't ask, but now that you're on the subject matter, why not?
So at the end of 3 years, let's say the company just retired it. So we have, I'm going to debit accumulated depreciation, 21,000. We're going to credit the truck of 40,000. 40,000. Now there's nothing else. So you're not receiving cash, you're not paying cash, so that's it. But the debits and credits do not balance. So in this case, you're only going to record a loss on retirement retirement at 19,000. Okay. So your carrying value or book value of the truck was 19,000. If you just retire it, you're losing the money, right? So that's where you are recording a loss here. Now for the last part, we're talking about the exchange. So follow the same procedure where you are going to debit accumulated depreciation of 21,000. We're going to credit the original truck at 40,000. Okay. Now in this case, the company is exchanging for a new truck worth 45,000 and as well as 22,000 cash payment. So what that means, just basically taking that information into your journal entry. When you're exchanging for a new truck, you are going to record a new truck. I'm going to use this as an indicator for a new truck. And the information given here, it says the value is 45,000. Okay. And also the company paid $22,000 cash in this exchange. So when you pay cash, you're going to credit cash, and that's 22,000. Now, after this, you have to see whether the debits and credits balance. Now on the debit side, you have a total of 66,000. On the credit side, you have 62,000. Okay, so you have $4,000 more on the debit side. So in order to balance these two, you're going to credit something by $4,000. Now in this case, credit is basically the gain on exchange. Okay. So this is the journal entry for the exchange. Any questions on this?
Why is there a gain?
So basically, it's like going backwards. So on the debit side, we have a total of 66,000. On the credit side, we have a total of 62,000. So they do not balance out. So in order to balance the debits and credits, you have to insert or add $4,000 of credit, right? Now, whenever you are crediting something, it's going to be something related to revenues or gain on something. So in this case, since this exchange is not part of the main business operation, instead of calling it revenue, we are going to call it gain on the exchange.
Yeah, but I don't see the gain. I'm sorry.
You don't see the gain?
Debit or credit aside, where's the gain?
Basically, in other words, you're selling your old truck for a new truck, right?
Yep.
Now, in that exchange, in that transaction, how should I phrase this? Even though you're paying cash, in other words, you're paying cash in a little smaller amount than what you're usually expected to. So if you're paying less than what you are supposedly presumptively required to, there is going to be a gain on that transaction, and that's what we're adding this gain on this exchange. Okay. Any other questions?
The last question, right? It should be in the question. It should be like in 3 years' time, because if this was only the question exchange for a new truck, then it does not say 3 years. That's why it was a little bit confusing.
No, okay. I mean, again, if you are selling something after a few years, we're talking about long-term assets. So you're using your long-term assets, and after 3 years, the value of that asset will decrease by a certain amount. And then we determined that the carrying value or the book value of the asset will become $19,000. So even though you're paying cash on top of your old truck, there will be a gain on this exchange because the value of the new truck is much higher than what you're actually paying for. Okay. Yeah, Audrey on the chat said something. Yeah. So that's the disposal of your long-term assets. And then at the end of last class, I had some tablet issues. So I wanted to go over the practice question once again to make sure that everyone is on board. Okay. So this company purchased store equipment for $42,000. The company estimates that at the end of its 10-year service life, the equipment will be worth $2,000. So that's basically the residual value or salvage value. During the 10-year period, the company expects to use the equipment for a total of 10,000 hours, grades to use the equipment for 1,500 hours for the first year. Calculate the depreciating expense of the equipment for the first year using each of the following method. So pretty much easy. So let's start with the straight line method. So for the straight line method, you're going to start from 42, the original price of the asset, and you're going to subtract it by the residual value, which was 2,000. Okay. And you're going to divide it by the service life, which was 10 years. Okay. So every year, you are going to depreciate $4,000. Very easy. That's your year one, the first year depreciation amount. Following the straight line method. Number two, if the company elects double declining balance, you're going to start from 42,000. And keep in mind that for the double declining method, we are not going to use the residual value or the salvage value into your calculation. So you're going to start from this, and you're going to multiply that with 2 over the service life, which was 10 in this case. So in the first year, the company will report the depreciation expense of, let me do quickly, 88,400. Okay, so that's the first year of depreciation expense following the double declining balance method.
So on double declining balance, it's clear you don't do the 42 minus 2.
No.
But why? I mean, that's a rule. I got it. But what's the logic?
Well, that's what the accounting professionals came together and agreed upon. It's like asking me why 1 + 1 = 2. I mean, it's pretty much given, right? So this is the method that the accounting professionals agreed upon when they first encountered the different types of method that they wanted to develop, and this is how they wanted to treat it. In the case of double declining balance method.
Yeah. I'll leave it
I think, yeah, I think I kind of get it. It's just that when you expect, like, if it's a 10-year thing, then you expect to only use for 3 years. You want to depreciate like most amount early, right? So you use double declining. But if you think it will go for 10 years, then you use like the straight line. But what do account professionals use mostly, Professor?
Straight line method.
Straight line.
Very easy. It doesn't have any bias to it. So most of the company use straight line method. For double decline method, it's mostly for tax purposes. But again, I mean, literally almost all companies elect a straight line method. So Martins says, I don't think there's a logic. Yeah, there's no logic. It's just how we came up with this treatment. I forgot. So makers. So Jason Lin is talking about makers. I think that's also a part of the accelerated depreciation method. But I have to get back to that. But I think makers you're talking about is part of the tax purposes using the accelerated depreciation method. But yeah, Marco Ball, that's for tax reasons. Yeah. So for the straight line method, let me just draw a graph. So let's say y-axis, let me have a depreciation expenses on the x-axis, time here. Finally, first time use color. Let me just use color. So if the company elects a straight line method, every year, the depreciation expense will be the same throughout the year for the duration of service life. But If the company elects a double declining method, the company will report a higher depreciation expenses, but as time progresses, your depreciation expenses will decline. As you can, this is pretty much the graph that you will see following the double decline method. Okay, so if the company elects double declining method, you will report a higher expenses. That means your net income will decrease. That means you will pay lower taxes. Okay.
That's lower taxes initially. But
well,
if you get it on recapture, you have to pay it back, right?
Oh yeah, but how should I say? Another thing that I want to mention, I guess, is that investors and companies are very short-term sighted. Like they really don't care about the long terms, right? So we talk about in the finance or accounting literatures and academic papers, we use the term called short-termism. Short-termism. So that means most of the investors, as well as the CEOs and the board of directors, really care about the short-term performance, like what they see right in front of them, rather than really making any judgments seeing 10 years ahead, right? Because their compensation and what analysts talks about in the market is how much the company made during this quarter, or how much the company will expect to make next year, not necessarily 10 years ahead, right? So because of the short-termism, their focus is on this first part. Okay. For activity-based, let me just quickly do it. For activity-based, you're going to use the original, okay, cost of that asset. In this case, you're going to use the residual value, okay, and you're going to divide it by the expected service hours, which was 10,000 hours. So that means for every hour spent on this asset, the company will depreciate, oh my God, 4. I hope I'm right. So $4 per hour. So in this case, the company used about 1,500 hours for the first year. So basically, you're going to multiply 1,500 by 4. So that's $6,000 of depreciation expenses for the first year. Okay. So again, during the exam, make sure that straight line method and activity-based method, you include the residual value into your depreciation expense computation. Whereas for double declining method, you do not ever include the residual value into your calculation. Okay. The last practice problem is this. I don't think I covered this because of the tablet issues. The company acquired recording equipment for $50,000. The company used straight line depreciation and estimates the residual value of $10,000 and a 4-year service life. At the end of the second year, the company estimates that the equipment will be used for 4 additional years. So basically, this is what do you call it? The change in the estimates during the service life. Okay. So in this case, at the same time, the company also changed the estimate residual value to 6,000. So originally it was 10,000. Now it's only 6,000 from the original estimate. Calculate how much the company should record each year for depreciation in years 3 to 6. So again, I think I talked about this previously. Whenever there is a change in the estimates for your depreciation expenses, treat it as if you bought that asset instead of just changing something in the middle of your calculation. That's the easiest way to tackle down these types of questions. So in year 1, the original cost is 50,000 and the residual value was 10,000. Okay, and the company elected straight line depreciation method and the service life is 4 years. So we're going to divide it by 4. So every year, the company is going to depreciate $10,000. So that's the first year. So what that means, at the end of year one, the book value of that asset now becomes 40,000 because originally it was 50. You're going to depreciate by 10. So your book value becomes 40. At the end of year two, your book value becomes 30,000 because starting from 40, you're going to depreciate additional $10,000. So your book value now becomes $30,000. Now, at the end of year two, there has been a change in estimates, okay? So at the end of the year two, we're going to change some estimates. Now, the company expects that the service life will become 6 years. So this asset has been used for 2 years. So when there's a change of service life to 6 years, there are 4 more years to go, okay? 4 more years. And your new residual value becomes $6,000. So for year 3, what's going to happen is that your book value or your original cost of that asset is 30,000 and your new residual value is 6,000. Okay? And you expect to use this asset for 4 years here. So you're going to divide that by 4. So what that means is that the company will depreciate $6,000 a year. Okay. So for year 1 and year 2, the company has been depreciating by $10,000. And because of the change in the estimates from year 3 to year 6, the company will depreciate only by $6,000. Okay. So in terms of the journal entry, you're going to debit it depreciation expenses of $6,000 and credit accumulated depreciation of $6,000. Okay. Any questions on this? Okay, so that was chapter 7, and we're going to move on to chapter 8. So for chapter 3, 5, 6, and 7, we talked about assets. Okay, so in the balance sheet, we had current assets, non-current assets, and we are pretty much done with the basics of the assets and different types of transactions that affects the left-hand side of the balance sheet. Now it's time to talk about liabilities. So on chapter 8, we're going to talk about the current portion of the liabilities that are reported on the right-hand side of the balance sheet. Okay. Over. So again, we're going to focus on the current liabilities. Now, the first learning objective is to be able to differentiate between the current and long-term liabilities. Very easy. Basically, the criteria is whether the liability is due within 1 year or beyond 1 year. That's basically the easiest way to differentiate between the current liability versus long-term liability. So we talked about this in terms of the definitions. Liabilities are the sacrifices of economic benefits or the obligations. Okay, so if the company is obligated to provide a service, or if the company is obligated to pay back for loans, for example, those are reported under liabilities section in the balance sheet. Okay, and usually liabilities results from past transactions. So for example, if the company borrowed money from a bank, that means the transaction happened in the past, and then you are going to report a liability. Or for example, if the company received money in advance for the services to be performed in the future, we talked about deferred revenues, right? For deferred revenues, these are liabilities as well. So again, if the company receives money in advance for the services to be performed in the future, those are also reported on the liabilities section. And these are, like, for example, we could be talking about customer deposits. deposits, or memberships, right? For membership. So for, I don't know how many of you go to Blink or how many of you go to Equinox, usually pay upfront, right? So when customers pay upfront, those are reported from company's perspective. They are liabilities, they are obligations for the services in the future. And after time lapses, the company will report the actual revenue after fulfilling that obligation. Okay. So most liabilities require the future sacrifice of cash. So for accounts payable, so since this is a payable, you're going to sacrifice your cash. So you're going to use your cash to pay back the payables. Notes payable, similar to loans, at the end of the term, you are going to pay back the principal amount, right? Salaries payable, you're going to pay your employees for salaries in the future, probably the next month or 2 weeks ahead. Deferred revenue, we talked about. Deferred revenue is a liability, giving up, not necessarily inventory, but basically for the services. Okay. So for current and versus long-term liabilities, like I said previously, the criteria is usually the 1 year. So if your obligation is due within 1 year, we are going to report it under current section of the liability. If the obligation is due more than a year, you're going to report it under long-term liability. Now, one thing to keep in mind is that, let's say if you borrow money from, how should I say this? Yes. Yeah, go ahead.
I'm kidding. You borrow money from a bank. Go ahead.
Oh yeah, no, I know what banks are. I'm just saying how to word this. So let's say if you borrow money from a bank, $10,000, due in 3 years. Okay, during 3 years, that $10,000. Hold on, let me do during 2020. Let's say a company or you borrow money, $10,000 in 2020, due in 3 years. At the end of 2020, you are going to report that $10,000 under long-term liabilities section. Okay, but at the end of 2022, that liability will be reported under current section of the liability, because that money will be due within 1 year at the end of 2022. Okay, so I just want you to provide you an example. The fact that your liabilities can shift from long-term liability to current liability depending on the contracts, depending on when the obligation is due. Okay. And then also the textbook talks about this operating cycle. So when we talk about operating cycles, we're usually talking about 1 year cycle, so from January to December, right? But for some other companies, for some special reasons, they can have longer than a 1 year operating cycle. In this case, this textbook talks about a winery, because winery requires brewing time, this fermentation time that takes years to produce wines. So in that particular example, the company will have longer operating cycle depending on how the company elects the operating cycle. But usually, most of the cases, literally 95% of the firms will elect a 1 year operating cycle. And then another thing that I want to mention is that most of the companies also elect January to December operating cycle, which is what we usually follow, calendar year from January to December. But for other companies, they sometimes choose or elect a different cycle. For example, let me just pull up Apple company here. So Apple company, for this company, the company elects the end of September, close to end, but September 28th or September 29th as the cut of the end of the year. So for that case, for Apple company, September 28th, 2018 to September 28th, 2019 is the 1-year operating cycle for that company. For Amazon, here, this is basically the calendar year. From January to December is the operating cycle for Amazon.com.
Why would Apple have a I mean, it's one thing to have September 30th, but what's with September 28th?
You have to talk to Apple. But there's no law that requires companies to follow only January to December. It's
Sure.
however the company elects to do for their financial disclosures. Okay. For Tesla, same thing. So January 1st to December 31st is their operating cycle. Walmart is different. So their year-end cut is January 31st. So what that means is February 1st to the January 31st of the next year will be their operating cycle. Okay, so different companies elect a different operating cycles. So that's something that you should be careful when you're reading the financial statements. One of the reasons why you should be careful when reading this financial statement is that, so for example, for Amazon that have December 31st or Tesla that have December 31st operating cycle, for those companies, their first quarter will fall in January, February, and March. Right? Those 3 months will be treated as the first quarter of the companies. Okay. Now, for Apple though, if September 28th is the cut of the end of the year, their first quarter becomes October, November, and December. Okay, quite different. This was Apple, this was Tesla, and Amazon. Okay, so whenever you read analyst reports or newspapers that talks about their first quarter of the company, you have to be sometimes you have to be careful. Are we talking about January, February, or March, or are we talking about October, November, December? Because depending on when the company elects the end of the fiscal year, the months they're referring to will be quite different. Okay. So whenever you're comparing the performance between Apple and Tesla, for example, you have to compare the first quarter of the Tesla or Amazon with the second quarter of the Apple company in order to basically compare the performance for the same period. Okay? That's another thing that you should be careful of. And interestingly, for Walmart, their first quarter will fall in February, March, and April. Okay, interesting stuff. Let me go back to this. Okay, yeah, this is not important. Yeah, I don't care. So basically, this is it. When we're talking about operating cycles, we usually talk about 1-year cycle. But the key is that the cut date or the end of the year or the months that falls in the end of the year can be quite different from company to another company. So that's just something that you should be careful of. Okay. So this is an example of current liabilities. Yeah, I don't want to look at this. Let's go back to the Apple. This was page 50. Oh, no. Nope, I don't want to talk. Let me just go back. Item 8, balance sheet. So for Apple company, current liabilities, they have accounts payable. We're very familiar with this. our other current liabilities, deferred revenue. We also talked about this. Commercial paper. We haven't really talked about commercial papers. So just briefly, I wanted to go over what commercial papers are. So the company issues unsecured short-term promissory notes, or in other words, commercial paper. So basically, that is the cash the company receives from issuing these promissory notes for general corporate purposes. And in this case, the company used the proceeds or the cash for paying out dividends or share repurchases. Okay, and since the company is essentially borrowing money by issuing these promissory notes, there will be some interest associated to it, and the rates range from 2.24% to 2.18%. Okay.
Is that the same as like a corporate bond?
No, it's different. Bonds can be years, but this is just it's like a little piece of paper. This is commercial paper, but it's different.
And bonds are usually secured. There's collateral for a bond.
Not necessarily.
Really?
Yeah. Bonds can be also unsecured.
Yeah, I guess you're right. Yeah,
Yeah.
that's fair.
But promissory, as you can see, so promissory notes is a very short term, usually like 90 days. I think it's usually the due date usually within 90 days. For bonds, it could be years. And when we are talking about bond holders, those are kind of similar to stockholders. So for stockholders, they hold the stocks of the company for years. For bond holders, they hold the bonds for years. But for stockholders, they have rights to be involved in company businesses. For bond holders, they do not have any rights for business operations.
But they can impose covenants and actually restrict your operations. So the rights are different, but bondholders do have covenants which govern how you run your business.
Yeah, could be. Yeah, covenants. Yeah, but that's too advanced. Let's not talk about covenants. Because I have an academic paper that deals with covenants, and they will drive you crazy. But anyways, at the end of the day, commercial papers are short-term borrowings with interest rates, as you can see right here. So usually due date is within 90 days. Yeah. Any questions? Oh, yeah. Anyways, so that was Apple. Let's talk about Amazon. I think Amazon item 8, balance sheets. So for Amazon liabilities, under current section, they have accounts payables, accrued expenses, and other unearned revenue. So unearned revenue and deferred revenues are the same. Michael Barr, what is your academic paper on covenants? So if, oh my gosh.
You can tell me after if you want.
Yeah, briefly to introduce my paper. So whenever a company borrows money from a bank, the banks usually impose financial covenants and accounting covenants, all sort of different types of covenants. And I talked about how the regulation can affect the structure of the covenants, but well, yeah, later on. But anyways, for Amazon, we have 3 different types of current liabilities. Let me just look at one more. Walmart, item 8, balance sheets. For Walmart, they have short-term borrowings. So that's kind of similar to commercial papers or promissory notes, accounts payable, accrued liabilities, accrued income taxes, and below them are long-term liabilities. Okay. Those are some of the examples. Which of the following is typically considered a current liabilities? Prepaid insurance is an asset. Okay. Mortgage payable due in 30 years. So that's long-term. Accounts receivable is an asset. So salaries payable is a current liability. So, I mean, salary is usually paid in 2 weeks or a month, right? So those are short-term current liabilities. Next section. So let's talk about notes and interest. And this is pretty much what we discussed in chapter 3, I guess. So notes are basically signed by a firm promising to repay the amount borrowed plus the interest. Okay, and we talked about this. I mean, whenever a company borrows money from a bank, you will report a cash on debit side, and you will report notes payable on the credit side. And at the end of the signing or at the end of the origination, you're going to report the principal amount. In this case, it's $100,000. Okay. And then this was on September 1st. Okay, so September 1st, due in 6 months. So what that means is that at the end of the year, December 31st, there will be some adjustments to these notes. Okay, so maybe this is difficult to see this. So let me just draw a timeline here. So on September, what was it? September 1st. So on September 1st, the company borrows money of $100,000. The interest is 6%. Okay. And then at the end of the year, there will be some adjustments to these notes. So 4 months has lapsed. So what that means is that you are going to report on interest, expenses, and credit interest payables. And the dollar amount that you're going to report is 100,000 times 6% times, it is only for 4 months from September 1st to December 31st. So that's 4 months out of 12. And I think we're given the number. So that's 2,000. Okay, so 2,000 debit, credit 2,000. Again, on December 31st, the adjustments is debit interest expenses and credit interest payables. Okay. Now on February 28th, or in this case, March 1st, okay, you're going to pay back the original principal amount. Okay, so at that point, you are going to pay back the principal amount, which is 100,000, and then notes payable. And this plus, you're going to also pay back with interest, right? So on December 31st, you had this adjusting entries. So you're going to reduce that interest payables by 2,000. 2,000. And between December 31st to March 1st, there will be some other interest accruing during this period. So you're going to have another interest that's original 100,000 times 6% times 2/12. The number is 1,000. Okay. So you're going to report another interest expenses of 1,000. And you're going to pay back of total 3,000. This is a journal entry for the notes. I mean, we pretty much did this on chapter 3. So hopefully everyone is on board with this. Any questions on this? Okay, good. So this is notes. So the company signs $10,000, 5%, 6 months notes payable. How much interest will be recorded by December 31st of the same year? So very easy. So principal amount, $10,000, multiplied by the interest rate, which is 5%. And from October 1st to December 31st, 3 months has been elapsed. So 3 out of 12. So at the end of the year, December 31st, you're going to report, oh my God, what's going on? 125. I'll fix that. $125 of interest expenses. Right? Accounts payable. I mean, very easy. If the company buys supplies, if the company buys inventory, we usually report it under accounts payable, right? So accounts payables are usually current liabilities. Yeah, I've never seen accounts payables reported under long-term liabilities. But again, depending on the contracts, depending on the terms of the payments, they could be reported under long-term liabilities. But in my case, yeah, I've never seen accounts payables reported under long-term liability. It's usually it usually falls under current liabilities section. Okay. And there are other types of current liabilities, deferred revenues. So we talked about this. If the company receives money, cash in advance for the services, you will report under deferred liabilities. Sales tax payables. So if you are a retailer selling goods to customers, you will collect sales tax, right, at the transaction, and that sales tax will be reported under other current liabilities. And current portion of the long-term assets, so we talked about this. So if the long-term debt is due next year, for example, that will be recategorized under current liabilities. Okay. So, I mean, we also did this. If the company receives money in advance, you will debit cash and credit deferred revenue or unearned revenue for the amount. Okay. And then when you actually fulfill the service afterwards, then you will debit that deferred revenue and record the actual revenue by crediting it. Okay. By 15. Any questions on deferred revenues?
It's essentially a liability, right?
Yeah, deferred revenue is a liability.
Okay.
Yeah. Hopefully you don't get confused during the exam or during the quiz. Sales tax. So usually depending on the states, depending on the states. Should I say depending on the states? Oh, that's quite tricky. Anyways, whew. So let's say there's a 10% sales tax. You will collect 15 plus the 10% of the price, which is 0.5. So you will receive cash of 16.5, but you're only report revenue of the original 15, and then another liability called the sales tax payable of 1.5. Okay. Yeah, so that would, yeah. So if the debt is due within the next year, you will recategorize them into current liabilities. Usually long-term assets span years. So if it is not due within the next year, you report it under long-term liability. Okay. For this, yeah, for sales tax, since we're talking about tax, I just want to cover just briefly one thing. By the way, today's lecture will be very short. Current liabilities are quite easy, so I plan to take some time to go over some real world examples, especially for this lecture. So for Apple 10K 25, there you go. So since we're talking about tax, what's happening with the corporate tax? That is a hot issue, right? For tomorrow's election. Anyways, so for 2017, the corporate tax or statutory federal income tax was at 35%, right? And Republicans say it's very high for companies. So during the Trump administration, the corporate tax rate decreased to 24%, okay, 10% decrease. And then in 2019, there was another decrease to 21%. So during the 2-year period, during the Trump administration, the corporate tax rate decreased by 14%, okay? But keep in mind that that does not mean the company is paying 14% less for corporate tax because there is an effective tax rate. So what that means is that if you're running a company or if you are familiar with tax codes, there are a lot of exclusions and deductions from the taxable incomes. So your effective tax rate, or what you're actually paying for tax relative to taxable income, is quite much lower than what the corporate tax, the statutory tax rate is. So in 2017, even the corporate tax rate is 35%, because of the deductions and because of the exclusions and because of the loss from the prior years that carried over to next year, this Apple company actually paid 24% for tax. In 2018, the company paid 18%. 2019, the company paid 16% of the corporate tax. Okay, whether 16% is high or low, it could be depending on your political affiliations. But what I want you to portray from this is that the corporate tax rates or statutory tax rates decreased significantly during this administration, and that is one of the factors why we see such a drastic decrease in tax rates, effective tax rates, as you can see right here. Okay, 16%. Wow, I wish I could pay 16% for my personal income tax. Jason Lin asks, is there any academic basis for higher? So so whenever, so in presidential debates or in news media, they talk about this trickle down effect. So we don't want to tax corporations because we want to save some cash for corporations for the benefit of employees and
Shareholders.
yeah, I mean, in economics, whether the trickle down effect do generate the benefit for employees or not, it's still not it has not come to a conclusion. On Fox, oh my God, I don't see. So on the Republican side, they usually say, yes, there is a trickle down effect. So that's why we don't want to tax higher corporations. They will provide more benefits by lower taxes. On the Democratic side, no, we are the government. We're going to take more taxes and use that money for the general population. So again, this is just a different perspectives. Ireland is 20.5%. Again, that's why your vote matters. Oh my God, today's election.
In a non-political thing, does the dividends received deduction result in-
Dividends are taxable, but dividends are the personal income tax. It's
No, I mean, if Apple owned other corporations and received income from other C corps, they get a dividends received deduction. So wouldn't that lower their effective tax rate?
Probably, but I'm not a tax expert. I'm an accountant. I'm an accountant, so you have to talk to someone in H&R Block or those dealing with taxes.
Oh, fine. Okay.
Yeah. Anyways, yeah, I don't want to get into more politics, but to tomorrow's election, I hope you guys voted. Yeah, this class never gonna end if we get into politics, so we're gonna skip that. Anyways, what I want you to talk about from this is that companies do disclose about their tax rates, how much they are paying for taxes. So that was on Apple. I think Amazon also talks about, let me just, anyways, literally all companies report something related to taxes. So you can easily find them in their financial statements, okay? So this is just one example. Moving on. Whew.
That tax information is not reported on a fiscal year basis, right?
What do you mean?
Well, I know that the financial statements were fiscal year, but I mean the tax information is just an actual calendar year.
Well, for tax, corporations have the same deadlines across all corporations. So yeah, that's something that I've never thought of. Yeah, depending on the end of the months of the fiscal year, their reporting number will be different. Yeah, but again, I'm not a tax expert, so I don't know how they do it.
Corporations
3D.
select different tax years, actually.
Yeah. Yeah.
They don't have to do calendar years.
Ah, I see.
Okay.
Woo! Lots of professionals who are experts here. So fiscal year corporation have different due dates for. Really?
And if 25% of their revenue falls within a certain time period, they can elect to change it based on the cycle of their time period. Like department stores have different year ends.
Mm,
Like they're usually, I think, end of February.
mm,
So if the question was, does everybody need to be December 31st? No, you don't.
mm. I have to think about that more. Yeah, but yeah. Anyways,
C corps-
again, I'm not a tax expert, so
Right.
hopefully, whenever I think most of you guys will take the individual tax and corporation tax as you pursue your masters or MBAs at some point, right? So you can refer to that professor for that question. Okay. And another thing that oh yeah, so current portrait of the long-term assets. The example that I wanted to show you is this. So here, so this is the fiscal year end of 2019. So future principal payments, they usually provide the breakdowns of the principal amounts by year. So this $10 billion will be reported under current liability sections. But beyond that, these numbers will be reported under long-term liabilities. Okay. And then, so contingencies. So last week when we talked about patents, okay, we talked about the possibility of litigations, right? Litigations for infringement, right? Infringement. So you're protecting your patents from other companies, right? And then we talked about this litigation costs, how they are reported. If you are successful in defending your patents, that number will be added to your patents. So that was the part of the litigation. And that was, so what we talked about last week was the outcome. Okay, so depending on the outcome, whether we're going to add the litigation cost and the attorney fees, everything to the patents or not. Now, there are cases where the companies sometimes report the litigations and the amount of potential losses during the litigation, even though without knowing the outcomes of the litigation. And that falls under contingencies, as you can see right here. Okay, so in this section, we're going to talk about how companies report its contingencies or not report the contingencies depending on the accountant's judgments here. Okay, so so if the lawsuit, so depending on the lawsuit, so if the lawsuit it has the likelihood that the company has to pay to the third party or to the plaintiffs, if the lawyers in that company thinks that there is a high probability that the company loses the case and then eventually have to pay for the losses, for the damages, the company will have to report that. Okay. Where sometimes the lawyers thinks that there is some reasonable possibility that the company will lose the case and have to pay for the damages, or sometimes the company has a remote possibility that the company will lose the case and have to eventually. So this probable, reasonably possible, remote is basically the determinant, one of the criteria that determines whether the company have to report these contingencies or not in the financial statement. If you're asking me, what do you mean by probable or what do you mean by reasonable possibility? Are you talking about 70% of the case. How should I even phrase that? So if the company thinks that there is a 70% probability that the company will lose the case, does that mean the company have to report it, or is it an 80% or 90%? There is no rule for this. Again, it always comes down to the judgment of the lawyers and accountants that deal with this. If their judgment says that there is a high probability that the company will lose the case, then the company will report it. For these two cases, remote possibility, reasonable possibility, the company might disclose it, but does not necessarily have to report it in the financial statement. Now, also, another thing is, even though there is a high probability that the company will lose, the amount of the payment can be estimated or cannot be estimated depending on the case, right? So at the end of the year, a contingent liability is reported only if the loss is probable, which was this case, and the amount is reasonably estimated. So again, it's all judgment, assumptions, and determinations by their lawyers and accountants working for the company. There is no rule of thumb that determines whether or not to report this case or not. But this is the brief overview of how the company treats this contingencies. Okay. So here, this is basically the summary of the table. If the company has a high probability of the outcome and reasonable estimates are, and then the company can reasonably estimate the losses, then the company will report this. Otherwise, they are either going to disclose it or not disclose it at all, depending on the case. Okay, you don't have to memorize this table, but just to understand that there are judgments involved in terms with respect to when and what to report in the financial statements with respect to the litigations. Okay, but when the company chooses to report in the balance sheet and the income statement, this is the journal entry. So the loss is 100 and the contingent liability is 100.
Is that a reduction of a contingent liability?
Is there a reduction of the contingent liability?
That journal entry of crediting a contingent liability.
That's the increase in liability.
It's an increase.
Yeah, so it's a liability. So by crediting liability, you're increasing the liability. Okay.
Yes.
Mm-hmm.
And loss is like an expense.
Yeah, loss is like an expense. Okay. Any other questions? So again, real world example. Let's see what Apple discloses with respect to legal and contingencies. So the company reports a liability when it is probable. So there you go, your term, probable that a loss has been occurred and the amount is reasonably estimated. So these are the exact language that the company uses to determine whether or not to report the liabilities or contingencies, okay? The determination of which requires significant judgment. So it's a lawyer and accountant's judgment to report or whether or not to report these contingencies. And it's also the auditor's role to basically double confirm the judgment of the lawyers and accountants with respect to these contingencies. And again, litigation and the final judgment in the federal district court is basically uncertain. We don't know what's going to happen at the end of the rulings, right? So again, it all comes down to the judgment. Let me go to Amazon. So let's see what Amazon talks about with respect to contingencies. So for Amazon, there are a lot of legal proceedings and litigations. So this company, LLC, sued Amazon, okay, in 2015. Amazon disputes the allegation of the wrongdoing and intends to defend ourselves vigorously in this matter. So what that language indicates is that they think that the loss, the the possibility of the loss is very low, and that's why it is only being disclosed in the financial statement without the numbers, without the dollar amounts. So you cannot really see the dollar amounts for that litigation in the balance sheet or the income statement. There is only a disclosure with respect to this litigation. Also, your last technologies, this company also sued Amazon. We dispute allegations of the wrongdoing and intends to defend ourselves vigorously in this matter. SRC Labs also sued Amazon. They think we dispute again the allegations of the wrongdoing. This company also sued Amazon. We dispute. Void IP company also sued Amazon. We
Did they ever
dispute
say that
allegations.
there's a likely settlement instead of always saying vigorously defend ourselves in the matter?
Yeah, I mean settlement. It could be agreement, or the judge can provide basically help settle the case. But that number is not reported in the balance sheet or the income statement. It's only being disclosed in the notes of the financial statement.
Mhm.
So this company sues Amazon. This company sues Amazon. This company sues Amazon. This company sues Amazon. So Amazon is, whoa, involved in a lot of legal proceedings. But at the end of the day, for the matters disclosed above that do not include an estimate. So that's why the estimate is not and the estimate is not can be measured. That's why we don't have the numbers in the balance sheet or the income statement. It's just being disclosed in the notes under the financial statements. Estimate is not possible or is immaterial. We may be unable to estimate the possible loss or the range of losses. So if the estimate is not possible, you are not going to record the dollar amounts in the balance sheet or the income statement. But this Amazon company decides to at least disclose what's going on with respect to the litigations under notes. Okay. But apparently Amazon is involved in a lot of litigations. I don't know why. Yeah. Anyways, so this was related to contingencies. Any questions with respect to contingencies? Okay. So I think this warranty is the last item under current liability section. So warranties, whenever we buy, for example, laptops or iPhone or any items or goods, there are going to be some warranties coming along with the products, right? So we are going to learn how the seller company accounts for these warranties, okay? So the company assumes that the warranty costs are estimated to be 30% of the sales. December sales are $1.4 million. Customers makes warranty claims of $12,000 in January during the following year. So basically these are the journal entries. So at the point of the sale, okay, you are going to use an estimate to report the liability. So your sale was $1.5 million, and based on the estimates, 3% of it will claim the warranties. Okay, so that's $45,000. So for the journal entry, you're going to report the warranty expenses by the $45,000, and you're going to report a liability. Okay, liability 45K. Now, warranty is a liability, right? The company has an obligation to provide a warranty for customers that claim the warranty, right? Now, if the customer comes back to claim some of the warranties, you're going to debit the liability. So that will reduce the liability by fulfilling the obligation. And in this case, the company credited cash for the repairs, or if the company elects to just replace the products, like what Apple does. Whenever you go to Apple Genie to fix your iPhones, instead of repairing it, you get the replacements, right? In that case, you're going to debit warranty liability by $12,000 and inventory $12,000. Okay. So for textbook, they used cash on the credit sides for the repairs. Depending on the situation, you can also credit inventory. Let me just use the full inventory for a full replacement of the products. Okay. So there's no rule of thumb with respect to whether the company reports cash or the inventory. It all depends on the transaction. Okay. Any questions on this?
Professor,
Yeah.
Is there a warranty revenue?
Is there a warranty revenue? Faye, I
Like-
was gonna do. Okay.
Like customer
Yeah.
buy this product.
Yeah.
buy
So here,
warranty.
the company on December 31st, let's say warranty is for 1 year. Okay. So the company expects or estimates that $45,000 will be claimed under warranty. January 31st, 12,000 has been claimed under warranty. So there is a remaining $33,000. Okay. Assume that no other customers claimed the remaining warranty. What happens is that the company at the end of the warranty, the period, the company will report debit warranty liability of 33K and warranty revenue 33K. Okay. Now, like what Michael asked in the first part of the lecture, why are we on the disposal of the assets? Why are we reporting a gain? Why are we reporting a loss on the disposal of the assets? Similar question here. Why are we reporting a warranty revenue when the warranty expires? The reason is that by, how should I phrase this? So when warranties expire, that in other words, that basically means you are fulfilling all the obligations, right? So warranty was a liability for the company. And at the end of the expiration of the warranty period, your obligation has been fulfilled. There are no more obligations to be provided for the customers. So once you fulfill all the obligations, you can basically report a revenue related to the warranty. It's like similar to deferred revenue.
When do you do this?
When what?
When do you account for warranty revenue?
At the point of the expiration of the warranty.
So if it was like a 3-year warranty, do you like perpetually account for every warranty or?
Yeah.
Okay.
That's how the company reports the warranty revenue. Again, we're doing it by hand, but under the system, right? In 21st century, we use computers, right? They will automatically report this warranty liability on a daily basis. Okay. So that's when you see warranty revenue. Thanks, Faye, for asking that question. Any other questions? Okay. Which of the following statement is true with respect to warranty liabilities? Let me just go straight to the answer. The warranty liability account is debited as actual repairs are made. So when customers claim for the warranty, you will going to debit the liability. So that means your liability will go down, and then you're going to credit cash or inventory depending on how what kind of service that you provide as for the warranty. Okay. During its first year of business, the company has sales of $300,000 and pays warranty claims of $10,400. Offers a 1-year warranty and anticipates the warranty cost will be a total of 5% sales. What is the balance of the liability? So the company made a sale of $300,000. The company estimates that 5% of the sale will be claimed under warranty. So that is a total of $15,000. And the company paid warranty claims of $10,400. $2,400. So let me just do a T account. Warranty liability. So from the sale, you're going to report an increase of liabilities, warranty liabilities by crediting 15,000. When the claims has been made with respect to warranties, you're going to debit. Okay. So at the end of the year, you are going to have 4,600 remaining warranty liabilities at the end of the year. Okay. So that's basically it, chapter 8, right? Quite fast. Let me quickly go over some of the practice problems and we are done for today. November 1st, year 1, the company borrows $60,000 cash from this. Company signs a 3 months, 8 months notes payable, interest payable, and maturity. Year end is December 31st. Record the notes payable by Daeun Training. So Daeun Training is the one that is borrowing money. Okay. So at the point of borrowing money, you're going to report. What am I doing? November 1st, you're going to receive cash, 60,000, and you're going to sign a note, notes payable, 60,000. Okay. That's the first part. Record the appropriate adjustments for the notes by the company on December 31st. Basically, you want the adjustments on December 31st. Okay. So since the company is borrowing money, you are going to report interest expenses and interest payables. Okay. The dollar value is 60,000 times 8% times from November 1st to December 31st. That's 2 months out of 12. Calculator. Okay. 60,000 times 8% times 2 over 12. So that's 800. 800 interest expense, 800 interest payables. Okay. Record the payment of the notes and maturity. So that was a 3 months note. So January 31st. On January 31st, the company will pay back, right? So you're going to debit notes payable of 60,000. You're going to pay back the principal amount, 60,000, and you have some interest, right? So originally on December 31st, you reported interest payables of 800. And also from December 31st to January 31st, there is a 1 month of accrued interest, and that's basically $400. So interest expenses of 400, and you're going to pay cash of 1,200. So this is a journal entry of the payment of the notes at maturity. Okay. Again, we did this multiple times in chapter 3, so hopefully you're very comfortable with this. On August year 1, the company borrows $2 million cash for whatever reasons. The loan is made by this company under short-term line of credit arrangements. Triumph signs the 6 months notes. I'll get back to you, Jason. 6% promissory notes, interest is payable maturity. Basically, this is the same procedure, except that you are talking about the lender side. Okay, so ISIS Bank. Oh, ISIS Bank is basically the one that's making a loan to the borrower. So
that's an OFAC violation.
Is that? Okay, anyways. So in this case, you're going to report a notes receivable, and you're going to report interest receivables and interest revenue. Basically on the flip side from the borrowing side. But I'm not going to get into detail. But just the different account names, notes payable, notes receivable instead of notes payable, and interest revenue, interest receivables instead of receivable interest payables and interest expenses. Jason is asking just a question about cash here. Any difference between cash? Oh, okay. So I tend to break this down into two separate items because basically to indicate that this is for related to the original principal amount, this is related to the interest, but you can definitely combine this two and say credit cash 61,200. Yeah. Okay. Yeah. Asian Cruise Lines is a defendant in litigation. So Asian Cruise is the one that being sued by a plaintiff involving a swimming accident of the cruise ships. Which of the following scenario determine the appropriate way to report the situation? So we're talking about whether the outcome is probable, reasonably possible, or remote. Okay. So if the likelihood of a payment is probable, that means the company will at least disclose the information in the financial statement. The question of whether the dollar amount will be reported in the balance sheet or not depends on the estimates. So the company estimates amounts of 1.5 million. So that 1.5 million will be reported under contingencies in the balance sheet. Okay. The amount is estimated to be in range of 1.2 million to 2 million. So if the estimate is in the range format rather than the exact amount, the lower number will be reported just for your information per se. Okay, so here in number one, the company will report contingencies of 1.55 million. If the estimate is in the range, the company will report in the lower number, 1.2 million. Okay. If the outcome is reasonably possible, remote, yeah, you're not gonna report in any ways. Okay.
If accounting is supposed to be, what do you call it, conservative, why wouldn't you record 2 million?
I do not have the answer to it, but we're talking about lawsuits that deal with or that involves like millions of dollars, if not billions of dollars. If the company elects to choose or the accounting principle mandates companies to choose the higher number, that will definitely affect your balance sheet and that will definitely affect your performance that analysts and investors use. Maybe that is one of the reasons as to why the accounting principles allow lower number with respect to this range. But to be honest with you, I do not have answer to it. Yeah. We or accounting professionals or FASB decided to elect a lower number when it comes to the range estimates in the case of the litigation. Okay. Warranties. So the company laptops. Anyways, yeah, lots of information. So 90-day warranty, okay, based on the previous experience, the company expects warranty costs to be approximately 4% of the sales by the end of the first year. Sales and actual warranty expenditures are these respectively. Does this situation represent a contingent liability? Of course, okay. Contingent liability, what that means is that the outcome is not for certain. In other words, we don't know the outcome at the point of the reporting date. Depending on how many customers claim the warranty, then the company can definitely report the exact amount for the warranties. But without knowing the outcome for sure, this warranty will fall under contingent liability. Okay. Record warranty expenses and warranty liability for the year based on 4% of sales. Basically, for the journal entry, you're going to debit warranty expenses. The amount is 600,000 multiplied by 4%. So that's basically 24,000. And you're going to report the warranty liability by the same amount, 24,000. Okay, record the reduction in the warranty liability and the reduction in cash. So basically, the information is the company will use cash incurred during the year. So whenever their customers comes back to claim the warranty, you are going to reduce that warranty by debiting liability of $20,000. And in this case, we're going to credit cash of $20,000. Okay. What is the balance of the warranty liability? So originally you increased liability by 24, you decreased the liability by 20. So at the end of the year, you have a warranty liability of remaining $4,000 reported in the balance sheet. Okay. Any questions on this?
Yeah, what happens if you like underestimate your warranty liability? Do you have to do anything, or do you just carry over a debit balance?
No, that means you have to, let's say, so this was an estimate, right? And then let's say it is 28. Let's say the actual claim is 28. Oh my God, my tablet is off again. Let's say the actual claim is 28. So what you're going to do is to no. You're going to reduce the original estimate of the liability, which was 24, and you're going to report warranty expenses of additional $4,000, and then you're going to credit cash 28. Okay, so you're reporting additional expenses with respect to the warranty. Okay, any other questions? Okay, so we closed the warranty. So no, so $4,000, there is no additional $4,000 of liability. So what's happening here is that at the point of the sale, the company in example 1. I'm not quite following what you're asking, Jason. I'm sorry. We closed the warranty liability of $4,000. I mean, again, there's nothing to close the warranty liability. We only had $24,000. No, we do not debit liability. Okay, again, so at the point of the sale, the company estimates that $24,000 will come as a warranty. Okay, but what actually happened was was 28,000. It was way over than what you actually estimated. So what the company, yeah,
I think you meant the 20,000, not the 28.
oh, so so basically I finally got it. Okay, yeah. So the estimate was 24. The actual claim was 20,000. Okay. The remaining 4. Okay. The remaining 4 is basically depends. So that depends on whether there are more customers claiming the warranty or not. But if the warranty expires without any claims, you're going to debit the warranty liability 4,000, and you're going to report the the warranty revenue of 4,000. Yeah, that's what we talked about previously. Oh, my handwriting now, it sucks. Okay, because we did it previously. Yeah. So if the warranty expires without any more claims, you're going to report a revenue and then decrease your liability. Okay. But any other questions? Okay, so basically that's the end of chapter 8. Yeah, very good. We have 2 extra credit presentations. Let me just pull up. I think, oh, no. So since we ended our class early, hopefully you guys can stay like 20 minutes more to listen to your fellow students' presentation, at least once a time. So we have Moise. Do we have Moise today?